But by just stepping in the interim, I think you have set the tone by putting the questions. So please put in as much questions you want, so I can curate it for all of you as soon as I think Bharat Bhai has come in. It's not audible. Yeah, Bharat Bhai, you can start. We have more than 300. I'll just start. Yeah.
Yes.
Okay, perfect. So good evening, investors and partners. Welcome to the quarterly Wisdom Insight session with Mr. Bharat Shah, Executive Director at ASK Group. I am Nimesh Mehta and I'll be your moderator for this webinar. Like earlier quarters, the webinar will be split into two parts. In the first part, we'll have Bharat Bhai share his wisdom and insight on the broader markets, macros, results. And the second part, he will try to answer all your questions. So request investors and partners to start typing the questions so that I can curate it at Bharat Bhai in the second half. Bharat Bhai, we met last quarter on 6th April when the Sensex was 59,500 and there was pessimism all around equities because the one-year return prior as on 31st March 2023 was flat to negative. FIs had sold more than 75,000 crores. And now in just 3 months' time, the whole mood has changed from extreme pessimism to optimism. Sensex has crossed all-time high levels of 65,000 levels. FIIs have bought more than 75,000 crores in the last 3 months' time. Our portfolio performance has bounced back between 15 to 20%. Fortunately, thanks to the trust of our partners and the clients, we have crossed our all-time high AUM of 36,000 crores. So the first question to you, sir, is what has changed in the last 90 days? And I just want to add the second question because that's very integral and connected to the first question. We have seen a lot of clients book profits or take back money redemption in the last 3 months. So you have seen many highs and lows in the last 32 years of your public equity investing. A lot of investors are today in a dilemma. What should they do? Should they invest? Should they profit? Do part profit? Should they redemption? They are in some kind of dilemma. So what would be your recommendation to other investors at 65,000 Sensex levels? So over to you, Bharat Bhai, for your opening comments, please.
Yeah. No, thank you, Nimesh, and good afternoon to everybody on the call. Delighted to be amongst all of you. To answer your first question, what has changed? If in simple terms I have to say, it is the emotionality, swings of the mind, and influence that external factors cast upon the mind. Beyond that, really speaking, nothing else has changed. There were not adequate reasons to be pessimistic prior to 3 months back. And it is not as if something dramatic has happened in these 3 months that suddenly things have to be more positive. And this emotionality, it is not only with somebody who puts in 1 lakh and 2 lakh and 5 lakhs in the market. This emotionality exists with foreign investors also who put in billions of dollars in and out. And therefore, really speaking, as we have discussed many, many times, prices are a function both of rationality and emotionality, while values are a function of only rationality. But because human beings are not a perfectly rational animal, as time and again immemorial over thousands of years, it has been proven that humans are emotional creatures. Market prices are merely an outcome of that emotionality. When emotionality is much higher and dominant, prices are relatively more affected by emotionality, whether of optimism or pessimism. Over a period of time, when things become a little more rational and reasonable and sober, it is the rationality which asserts, and therefore prices move closer to their real value. Therefore, you see, really speaking, that question has to be answered along with the second question that you asked. That people have written because they got a sigh of relief that things suddenly, in their opinion, seem to have improved. Whether in reality 3 months have altered anything fundamentally too much, not to my opinion. But when, unless and until you really need money for certain purpose and you cannot do without it, I would like to submit that any highs that you are seeing, whether today, whether 2 years back, or whether 5 years back, all those highs, as well as the ones which will come 3 years down the line, and 5 years down the line, and 10 years down the line, they all are interim stops. The high is at a point of time. It is not high for all times to come. And therefore, unless you have really reason to take any money off the table, and you really have reason to put that money to something to work, in my opinion, it will not be in your financial interest to withdraw it prematurely. Because let me once again put a view. What I discussed last time also, when things were looking, as you described, more gloomy and more pessimistic. But even then, the same view I had reiterated, and I am reiterating again. India is standing at a cusp of, I have no doubt in my mind, one of the greatest economic expansions, not only compared to its own history, but compared to what any other major economy in the world will do. This economic expansion is not only unprecedented in terms of the sheer magnitude and therefore the growth rate of the GDP, but even more distinguished is going to be the factor that qualitatively, probably it is going to be the best ever that we have witnessed over decades. The qualitative aspect of growth usually is neglected or not paid as much attention to, because qualitative is not a number and therefore it is harder to comprehend. Numbers people comprehend more easily, and therefore they think that is the only thing that describes what is there to be had or what is going to be an outcome. But qualitative factors have a far bigger impact on the value creation than people are willing to understand or willing to give a credit for. And therefore, qualitatively, in my opinion, the growth ahead of the economy is going to be one of the best ever. And it is not only high growth rate of GDP that we are staring at, but more predictable, more solid, more sustainable, and backed by superior capital efficiency, superior return on capital employed, superior return on equity. Therefore, these large economic expansion translating into superior GDP growth rate, backed by superior quality of the growth, is a phenomenal recipe for converting that outcome into business profits and cash flows, and therefore their valuation. In turn, that will reflect in the wealth and the value of the holding of the promoters and entrepreneurs of the businesses, the owners of the businesses. And finally, investors who are able to appreciate this game, that is a long game that is available. Short games are more of excitement and tactical and more fun, but long games are the ones which create serious amount of money and serious wealth, where things sustain for a long period of time. And I think we are in a stage of long game, a game which is going to play out in beautiful way, where not only the growth rate will be superior, but quality of growth rate will be superior. And therefore, the two together are a fantastic recipe for value creation. Patient investors, wise investors, long-term investors, disciplined investors, I think will make kind of money which is unprecedented, which has not occurred ever in the past. And I'm repeating, I'm not talking about 2 years and 3 years and 5 years down the line. I'm really talking about 10 years and 15 years and 20 years and more. Therefore, uh, even in a case of country when it is on a great move, when the game is long and strong, both, there is a phase, and that phase is a time when you make a huge amount of disproportionate amount of wealth in your overall wealth accumulation in your lifetime. And I believe India has already entered into that phase where the next decades are going to be among the most defining ones. And the people who can appreciate that opportunity and the long and powerful game that is before us will have in the unfolding decades among the highest wealth creation out of the total wealth that they will probably count after those couple of decades also. That is the opportunity. Therefore, in that opportunity, index of 60,000 and 65,000 and 70,000 and 80,000 and 1 lakh and 1 lakh 25,000 and 1 lakh 50,000 are merely interim stops. At every stop, you will count the number and say that it is a new high. Of course, it will be a new high, but it is not an ultimate high. And therefore, unless and until you really have any material reason to pull money out of the markets into something else, which you think will do much better than the markets magic will produce, barring that reason, walking away from the game, or just because there has been a rather a nice rise in these few months, is not a very intelligent investment reason for anybody to withdraw. I don't know how else I can put it, but as I mentioned last time also, my mouth salivates. Many of you probably, I suppose, are much younger than me, and therefore you probably much more decades to compound. But even in whatever period of time that I have to count for myself going ahead, my mouth salivates because when a country is on move, as I mentioned, when the game being played is long and powerful one, it is that phase which makes disproportionately large part of the wealth accumulation in your entire lifetime. And we are already we've entered that game, and the game has just begun in my opinion.
Sure, Bharat. Generally, we meet you at the start of the quarter before results. So, request you to share your thoughts on the Q4 results of our portfolio companies and the views forward for it.
Yeah, I mean, across our different portfolios, if we compare the top line, that has grown at the rate of 9 to 12% compared to last year, that is the fourth quarter top line. Please remember, last year, fourth quarter March, that is 2022, was an exceptionally strong quarter. So it was not a normal quarter, it was an exceptionally powerful quarter in terms of the earnings. And therefore, on top of it, in the March 23 quarter, the top line growth of 9 to 12% across different portfolios, in my opinion, is very, very satisfying outcome. Profits have grown at a rate much, much faster. Therefore, operating profits have grown at the rate of 20% 1% all the way to 25% across different portfolios. So on a profit growth, it has been an exceptionally strong number on top of what was a very good quarter in March 22. The profit before tax and profit after tax have similarly expanded in a very nice, comfortable way. Year in entirety, if you look at the year has been an exceptional year for the portfolios. Top line has grown for the entire year of 23 compared to 22 by almost about 23 to 28% top line. The profits have grown in the range of 25 to 30% across different portfolios. So year in entirety, profit growth and the top line both have been very healthy, well in excess of 20% for the top line operating profit and pre-tax, post-tax profit kind of a scenario. But even more importantly, the quality of growth has further accelerated. Debt equity ratio has come down in our portfolio. In any case, debt equity ratio has been negative. That means companies in general have no debt or cash on hand, but the extent of cash on hand is increased. But even more importantly, capital efficiency number, return on capital employed and return on equity, both the numbers have improved compared to the last year. So not only it is the growth rate which has improved, but it is the quality of growth rate which has improved further. And Indian corporate sector in its entirety, the March 23 numbers are still not fully out for the corporate sector. But I believe the Indian capital efficiency, corporate sector efficiency numbers probably will be, if not the highest in the world, certainly will be the second best in the world. Therefore, whether it will be either similar to America's return on capital employed and return on equity, in all probability, the numbers would exceed that of America. Therefore, in qualitative terms, probably we can make an assertion that Indian quality of growth today is comparable to the best in the world, if not the best.
Bharat, the natural question to your bullish opening comments is for many people asking that if you're so bullish, which of the sectors are you overweight and why, and which will lead to kind of a growth in performance for our portfolios?
Well, we have good weight in lending area. Lending itself has a very good weight in the markets. So ours is not very different in that sense. But I think lenders would do very well. A lot of things have happened. Lenders' balance sheets have improved. Borrowers' balance sheets have improved. Cost of capital has come down. Avenues for lending have opened up because many areas of demand for lending have opened up. Consumer demand, capital for new capital formation related demand for capital, export related demand, growth of the business and therefore working capital related demand, infrastructure, real estate, all of these areas where demand for capital has been very strong. MSME sector, rural area, the growth rate, the rate of growth for new capital, new borrowing is actually the highest. And therefore, many sources of demand, sophistication on the supply side instruments of the finance, superior quality of the asset book of the lenders, reduce leverage of the lenders, reduce leverage of the borrowers, and therefore condition cannot ever be more favorable than this, I would think. I mean, this is where every single S is in your hands. It is in that kind of a situation. And valuations also still are not very demanding actually for the lending side. Therefore, We believe lending is one area where opportunities multiply several fold over a period of time. Insurance is one area where we continue to believe penetration levels are low. Incomes, as they rise, will mean not only penetration would improve, but extent of underinsurance will reduce. And therefore, insurance is one area, both life and non-life, where decades of very healthy double-digit growth is clearly visible. We have good investments in chemical side as well as active agrochem specialty side. Um, on the chemical side, I think the first quarter results for June 23 will be muted and will actually be softer compared to the comparable numbers in last year. Or may not be compared to the last year as much, but compared to March quarter, the numbers will look relatively softer. But I would say it is a bit of a temporary condition where there has been a bit of a pressure on the finished good prices, and there has been so far the squeeze on the raw material side. In a couple of quarters, we'll see the squeeze on the raw material side actually will turn favorable. And the top line, which is a little muted in the current situation because of the Chinese dumping, also will get sorted out as the inventories get cleared out. Therefore, there will be a temporary 1 or 2 quarters of a relative softness on a sequential basis, but otherwise, structural story of the specialty chemicals, active pharmaceutical ingredients, and specialty agrochem ingredients remains intact. Uh, we also believe that consumer businesses will do very well, and consumer no longer in India is merely staples or fast moving consumer goods. At one point of time, when you talked about FMCG, it typically meant only largely consumer staples, but today it is consumer durables, consumer luxury, discretionary consumption, and staples. Many things are rolled into one. And therefore, consumption itself is a very layered and large area of activity. So we have quite a meaningful presence in that area, and we think we should be gaining advantage of that. I think telecom will be at a forefront of revolution in digitization of the country, in embracing digital commerce and digital technologies by individuals, by businesses, and therefore as the power is moved from the mainframe to the desktop to the laptop to the mobile phone, and the power really is being unleashed by telecom firms eventually. And so far, what we have seen is lowest pricing in the world, and even at that price, businesses are making healthy return on capital employed and healthy growth of the profits. I think at some stage we'll see the power of the pricing also will be unlocked. Indian prices are not only cheapest in the world, but cheapest by an unbelievable margin, and therefore very large and significant consumer service as well as business service is available at a pricing which is unthinkable in most parts of the world. Therefore, along with the opportunity where things are moved into mobile, and along with the pricing power that will be unlocked and other technologies which are mounted on top of telecom and the platform, this is one area where significant long-term opportunity continues to exist. There are others as well. Automobile, where we relatively have softer exposure, where we need to get more meaningful exposure. But automobiles also continue to offer a meaningfully large and significant opportunity. These are some, there are others. but I'm just covering a few of them.
At least 7, 8 people have posted different questions, but what they are saying is that while the bounce back has been fantastic, there have been little bit higher single digit returns over 2 and 3 years. So how long do you think we will be able to, see a double digit kind of a return? Would that be 5, 7 years? And your thought, because they feel a little bit of single digit return is not satisfactory to the equity, and they have a lot of faith with ASK.
Let me answer it in 3 parts. Whether for a defined period of any particular period, whether 2 years or 3 years, I don't know, but let's say it is 9%, 9.5%, or whatever that number. Certainly, I would say that is not a number that we are angling for. And whether that is a number that we should be slating for a time to come, I'll be very disappointed if that were to be the case. Second, let me reiterate what we have many, many times mentioned, and I'll once again reiterate that. There are two things which are dear to us, and we think both of our important objectives as well as something that we are accountable for, responsible for. So I'm putting those words very carefully. I'm not only saying that these are important to us as objectives and dear to us as objectives, but I would say we are accountable for that over a period of time. These two objectives are absolute and relative. On an absolute basis, we believe investing has to generate absolute, positive, reasonably healthy, and satisfying compounding returns over a period of time, irrespective of the behavior of Mr. Market. If Mr. Market is not helped, but so long as Mr. Market is not obstructed, even if Mr. Market is not helped, it is our duty to generate a positive, absolute, reasonably healthy, compounding returns over a period of time. And that we have to achieve by prudent stock selection, by mitigating risk at each name, as well as controlling risk at the portfolio in totality, so that there is an optimization of returns vis-a-vis the risk that is implicit in any investing activity. The second part is the relative one. The purity of investing is all about absolute attainment. Relative is the way world looks at it, because that's the way world compares to a benchmark or to the peer and whatever. On a relative basis also, I believe when you are focused on purity of investing in its core tenet, on a relative basis, also we have to generate a meaningful difference over a benchmark. And as I mentioned, not only we think it is a healthy situation to aspire for, that is satisfying absolute and superior relative, but I would say we hold ourselves accountable, if not responsible, to attain those outcomes over a period of time. If we fail to achieve that, it will be our failure, and it will be the blame will lie only at our end. I always believe markets are what they are. Markets are perfect. Markets, I have never any difficulty and problem with, even when the markets are among most trying ones and difficult ones at point of time. Markets are what they are. We have to do what we have to do, and markets are gracious, generous, so long as we behave well with discipline and character and with a long-term situation in mind, rather than getting tempted by short-term pressures or attractions. We always have to be accountable for satisfying absolute and superior relative outcomes over a period of time. The last part I'll put, you take any of our portfolios with a vintage of more than 10 years, whether we take Indian entrepreneurial portfolio with vintage over 14 years, India Select with about 15 years, Growth with 22 years, Life with about 16 years, all our portfolios with a vintage in excess of a decade and more have produced absolute returns over their respective vintage duration, ranging from all the way from 16% compounded to 20% plus compounded. Growth portfolio over a 22-year has produced 20% compounded absolute returns, net of all expenses and fees. But all of these portfolios have produced an alpha ranging from 3.5% compounded per annum all the way to 6.5% compounded over the respective durations. Therefore, both reasonable absolute, satisfying absolute, and reasonable relative superiority may or may not be the kind of numbers that I just now mentioned, but still healthy enough numbers, I'm repeating, is both possible as well as our duty. And lastly, in any difficult period, in any difficult year, if you look at the year thereafter or 2 years thereafter, the 2 or 3 year numbers still will look difficult and challenging. Supposing in a year when markets have lost 30%, and that has occurred in last 20 years, 22 years, 3 or 4 times. And even if you have lost less than the market, and let's say you have lost 20, 25% in each of those periods, it will take some amount of time before you recoup when you suffer that kind of a negativity. Whether markets will take time to recoup that negativity, portfolios will take some time to recoup that negativity. But these are just events in a over the journey of time. These events, we shouldn't get carried away or get unduly influenced. Ultimately, in last 22 years, if you look at it, 3 dramatic events have occurred in the market. We saw it in 2001 when markets lost almost 58%, 2008-9 when Nifty lost 68%, and we saw post-pandemic immediately after March 22, in a matter of few weeks, Nifty lost some 37, 38%. Apart from these 3 dramatically difficult periods, there have been 3 other periods where indices have lost 25% and thereabouts on 3 occasions. Despite 3 mega events and 3 sufficiently sharp events, still markets have done decently well, and our portfolios have compounded at a healthy level. So I would urge you, keep us watching, keep us holding accountable. When we don't produce a return in a particular period as satisfying as you would like it to be, and we would like it to be, but it is just one of the points in an interim journey. And ultimately, it will be tempting for me to say, okay, in next 3 months or 6 months, it will be happening, or it will happen in 9 months. The returns will reach a level where it is satisfying, but it will be not only foolish on my part, but it will be unethical on my part to venture any such thing. I do not know is an honest answer, because short term I in any case never know. At least I have zero capability to predict short term. Many others seem to have that capability, is judged by TV programs where people very easily make pronouncements in next 3 months and next month and next 6 months and 12 months. I wish I had that capability, but I don't have that capability. So I will refrain to make any such judgment. But without any doubt, I believe things will be far better than what in 3 to 5 years time from now than what they are today. Things will be even better 10 years down the line than what they will be 5 years down the line, and so on. Therefore, once again, these are just interim stops. And one final point, which is a philosophical point. If you follow the discipline of investing, and if you have a philosophy of investing which you follow ardently with discipline, with intensity, then I would say it is not only probabilistic, but it is almost inevitable that there will be periods when you will underperform the markets. And I'll explain to you the reasons for that. Earlier itself, I mentioned that prices are affected both by rationality as well as emotionality. And market is nothing but a sum total of different prices of different businesses. Therefore, market at any point of time is a sum total of rationality as well as emotionality. Values, which is where prices eventually have to go to, are determined only by rationality. Our portfolios are built based on the rationality that we understand. Therefore, there will be times when markets will be more emotional and less rational. And therefore, prices will be affected much more by emotionality than by rationality. In those periods, if we try to mimic markets, then we will have to act emotionally and try to match the markets. Not only that is not possible, actually that's a dangerous game to play, because when we try to mimic market emotionality, we are playing in our areas of weakness and in markets areas of strength. When we play by rationality, we'll be playing in our area of strength and in the area of weakness of the market. And it will be foolhardy to play the game in a manner where you play as per the competition strength rather than your own strength. And therefore, given the fact that markets are an amalgam of rationality and emotionality, invariably there will be periods when you play the game based on rationality and continue to do that, you will look out of sync with the markets at some time. And during these times, if the markets are irrationally positive, you will underperform. And there is not that we are seeking that outcome, but I would like to point out that it's not a shame to have that, because it is inevitable in any long-term investment journey. Sorry for a long answer, but I thought I'll cover it in its all aspects.
No, thank you, Bharat, for your candid and honest answer. And before we move to the stocks, a lot of stock questions are there. I will just pose one more question on the portfolio. One of the portfolio, which the last I'm reading, again, 5-6 questions have come. Sagar Kapadia has written, Nimesh bhai, why is EOP portfolio? We bought, we're happy with IEP, but we bought EOP later on, but EOP hasn't been able to do. Somebody has put EOF, AIF. What are your thoughts on that strategy, particularly the mid one?
No, it will do what it is supposed to do. It will produce what it is supposed to produce. Few months, few quarters. Again, I have to repeat what I said just now, or in a very elaborate way. There will be periods when markets are in a certain direction, and your portfolios have to be based on what you think is the long-term journey that portfolio is to carve out. And therefore, there will be periods where, compared to market or compared to our other offerings, some portfolios may look higher and some may look lower. But all our portfolios are designed to do the two objectives that I mentioned: absolute positive of a satisfying nature and relative superiority over a period of time. And EOP is no different. In my opinion, it's a beautiful portfolio. My own family's personal significant money is invested there, and not only in EOP, in many other strategies. So I do eat what I cook myself, and I remain very, very positive on the outcome that a very good EOP portfolio has to produce over a period of time.
Thank you, Bharat. And it's a pleasure, or I can see the clients also responding. When you have put your own money, there's a lot of conviction that comes in there. Now let's move to a few stocks, and maybe we'll start with the new stocks. At least again, 4-5 names I've mentioned. This is the third pharma company or API company who have come in and recently bought Dr. Reddy, but they claim that it's been slightly expensive. So can you just throw some light of why would Dr. Reddy come in, and what's your thought on pharma API as well?
Well, say Dr. Reddy, let us split its businesses into different parts. The first and the large piece that they have is America business, which is both generic and a level of specialty business. Then there is, you see, Asia kind of geography, where they were significant business, Asia and Europe. Then Russia is again an important territory for Dr. Reddy, and in fact, that business is actually expected to do even better going forward, given the way situations are. And fourth business is their domestic business, which is where they are little below in the ranking. There are people like Sun Pharma and others who are ahead of Dr. Reddy. But I think they have a very credible strategy on the domestic part of the business, which is not only very healthy and predictable growth activity. Domestic pharma industry itself has been growing in a very steady, decent, predictable 10 to 12% kind of a growth rate. Dr. Reddy has now put in place strategic levers to drive that growth little higher than the industry growth. That means their market share will improve and they become higher up in the league table. One part of the strategy is of the generic. The other part of the strategy is based on innovation chemistry being applied in the domestic market and solutions which are being sold. And I believe there are good reasons to think that these are very sound strategic thoughts and the way it has to be delivered. Therefore, domestic part of the business has a good chance to grow ahead of the industry, and profitability will be compared to Dr. Reddy's own margins in that area will inch up, and therefore profits will grow at a rate even faster than the top line as far as domestic business is concerned. In America, they have a good position. Most of the players have vacated the turf. So really speaking of the large players, from India, if you have to talk about it, is only Sun Pharma and Dr. Reddy. Most others, including Lupin and others, have kind of fundamentally withdrew from the American markets. Dr. Reddy is a decent strategy. Even current year, if you see the numbers and the last 2-3 quarter, their numbers based on a specialty solution that they have come up with a few months back and which is doing well. These kind of introductions, Dr. Reddy, based on innovation capability in the pipeline, is capable of. And compared to all other Indian players, barring, I would say, Sun Pharma, they have a much better chance to do well in that geography. Pricing pressure in America also is abated, and we can see it in the numbers where pricing pressure has been coming off. Thirdly, Russia, I mentioned, that is actually a piece where they will do much better. Russia has been a traditionally strong territory for Dr. Reddy, and given the fact that the geopolitical situation, Russia is increasingly leaning much more on India for their pharmaceutical solutions. And therefore, a player like Dr. Reddy has a much, much better chance. The remainder of the markets in Asia and Africa and Europe, uh, there are different levers and different moving pieces, but net, even in that geography, the levers that they put in place, Germany, for example, where many others have struggled, but they are doing decently well. And double digit kind of a growth rate with improving margins. So net, we think that Dr. Reddy will deliver steady rising profit despite skepticism that market seem to have displayed for the company for a while. Some reasons for that skepticism are valid, but I would say, really speaking, they put in place a very credible strategy on different parts of the businesses, run with a very strategic clarity why top line will grow and why margins will grow. And net end, we think the business is not particularly expensive. If you strip off one particular solution, which is in the specialty basket in America, and because it will not remain forever, if you adjust the value of that, which is about 300 to 350 rupee per share, the rest of the business is available at about 22 times on the next year's earnings. So it's not particularly demanding and high. And I think in terms of the management, the CEO, Israeli, who is driving that business, is a very astute and very sensible man in the way that business is strategically run. So valuation is reasonable. I don't know why it is felt to be expensive, because it is merely about 22 times. That's not unduly harsh or high. And with a reasonable long-term growth, barring the one-time kind of solutions which will keep coming time to time, which we don't count it as normal profit, but which we count it as a kind of a one-time value to be reduced from the market price. The business top line will grow at a reasonable, healthy double digit, and profits have a very, very good chance to grow more in the territory of 15 to 20% compounded.
Thank you, Bharat, for giving so much of conviction, Dr. Reddy, and so much of depth of going each stock. I'm naming 4 clients who have a name: Ajay Papat, Nitopal Ganguly, Mahesh Thangaraju, and 2 anonymous attendee have put question on why are we continue to hold Page Industries, and the last quarter results were not good. Over the last 1 year, it has not delivered up to its mark. So what's your rationale in holding Page Industries?
No, 1 year results have not been good is incorrect. The September 22 quarter was the highest quarter in the history of Page Industry. And the December 22 quarter was even a bigger blockbuster quarter in the history of Page Industry. So for 1 year, the business has not delivered results is incorrect, first of all. Because September and December, the last year, 2 quarters, they produced the 2 biggest quarters in history of Page Industry, both on the top line as well as on the profits. Secondly speaking, even in terms of the price performance, the highest price it touched was actually around September 22. In that period of 2-3 months, where price touched almost about 54,000 rupees. It is corrected from there in last few months to be about 36 and a half, 37,000 crore, 37,000 rupees. Therefore, it is corrected almost by, you can say, 30% from that peak. The reason why March quarter was a difficult one, my apologies, June 22 and September 22 were blockbuster quarters. December was affected quarter, but not so affected. It was March 23 quarter which look impacted strongly. Now, it is not page industry alone which suffered in that quarter. It is actually the entire industry lost the situation in that quarter. If you look at results of names like Rupa, or if you see names like Lux Industry and others like Amul, the drop in their turnover was in some cases ranging from 20 to 30%, and the profits have dropped 70-80% in those cases. Page industry not only has maintained its market share, but has actually grown the market share. And page industry, while margins came down, still margins did not come down as dramatically as it came down for the others. That's point one. Second, even in a difficult period when sales were affected and the entire industry was in difficulty, they did not reduce their advertisement and market building activity. They continue to spend about 4% of the turnover on advertisement and market brand building activity. And therefore, unlike many other consumer businesses, when quarterly profits are affected, or quarterly business is affected, they cut down on advertisement temporarily and show the improvement in the performance. Page industry has not done that. Not only they have continued to spend, they continue to build even more on that advertisement spend. Third has been a very strategic reason. They have undergone complete digitization of ordering and inventory with the entire distribution network. Now, initially there was a resistance because some of the distribution networks run with little less formal capital. Let me put it in a euphemistic way. They try to manage their business with bit more of informal capital, and they try to sort of say not fully be transparent about the data of their offtake and actual pickup by them from the company. But page industry, unlike the rest of the industry, has insisted on complete distribution chain level digitization. Today, company is a day-to-day basis, item to item, SKU to SKU, dealer to dealer wise visibility of what is the offtake and what is the inventory with anybody. Therefore, they've implemented automatic inventory replenishment system. Now, when you implement a very complex technology project of this kind, where long term it will give very efficient inventory management, as well as very predictable ordering and sale review. But in a shorter period, when whole system is adapting, there is a disruption, and therefore there is some amount of slowdown in offtake. Even though industry sales have been sluggish, they still have gone ahead with this initiative rather than taking any short-term step. On a long-term basis, it shows strategic clarity and vision of the firm rather than getting carried away by short-term consideration. And I would like to say even June quarter will have softness. Not as soft as March 23 quarter. It will be better than March 23, but it will still be soft. And mind you, June 22 last year was an exceptionally robust quarter. Therefore, in comparison, it will look to be even more affected. September quarter, they will further improve compared to the June quarter. But please remember, September 22 also was the second best quarter in the history of page industry. And therefore, in comparison to that quarter, it will still look soft. But from third quarter onwards, page industry, in our opinion, will get back to its normal growth rate as well as normal margins. And in a system which working capital wise will be even more efficient than ever before. With great help on production planning, inventory replenishment, and sales and distribution efficiency. Already, page industry had the lowest working capital in the entire industry and has always generated exceptional return on capital employed, 55-60% plus. But with these initiatives, it will be even better. And the cash conversion cycle will be even stronger than before. And therefore, all in all, we feel actually this is a very, very good opportunity to lock into page industry today, because effect of softness of turnover and reduction of margins due to raw material situation, strategic steps taken due to higher ad spend and all of that, that impact is visible. But the benefit of expanding and normalizing margin plus growing top line, improved capital efficiency, improved inventory management is not factored into the price. And therefore, what may look like a challenge is actually an opportunity, is what I would like to submit.
Great. Thank you, Bharat. There are two clients, if I can name them. They have asked your thoughts. Again, more on the price performance of Sona BLW
Yes.
over the recent past hasn't been up to the mark. Again, I'm referring, they refer to the price performance and the story on Sona.
No, story on Sona remains kind of heartwarming. They are principally in two important businesses within the automobile component space. One is motors, and second is differential assembly drives for EVs. In both of these areas, they are at a global scale and they hold a global market share. So they are not a small or tiny player. They are a large and stage one supplier to their clients and globally. Secondly, they are not plain and simple vanilla manufacturing entity. What they are is into technology-based manufacturing and engineering, and that is evident even in the R&D spend that they do and the R&D team that they build in a relatively smaller size of the business compared to, say, much bigger auto component players. Sona has far bigger R&D team than even the biggest auto component players have. It's a team of 350 people in R&D side, and not a single auto component company can boast of that kind of a number on R&D alone. So they are not in a mundane commodity solutions. They are into quality, upper end, technology, age driven solutions in the business. The third factor, the last year they've been affected not because of any internal situation, but because their clients are affected. The whole world was affected. Ultimately, they supply to their clients. The clients are basically automobile makers. If automobile makers are not able to sell or are not able to produce enough, there is nothing Sona can do about it. Sona has 4-year and 5-year business visibility based on the contract signed. But the client has to lift the order, right? And therefore, that is the challenge. Last year, as you know, supply chains were disrupted. War still has not gotten over, and the war clearly affected the supply chain much more. You are also aware that semiconductor availability was a significant issue. It is reduced in intensity, but still semiconductor issue has not gone away. It may be small part, it may not be very expensive part of the automobile, but you need many semiconductors. All automobiles are now more electronic and not really engineered products. Engineering part of the products has reduced. It is much more electronic and chips and digital. And therefore, even though those semiconductors and chips are very cheap, $2 and $3 and $1, many different parts each. But every modern vehicle uses from hundreds to thousands of those chips into a vehicle. The availability of semiconductor and chips was affected. It is still not fully gone. There is still a challenge on some amount of procurement of semiconductor. That in turn has affected sales. And that in turn, sales of automobiles. And that sale of automobile is affected Sona's supply to their clients because they supply to the automobile makers. So it is nothing to do with their internal capability or internal issues. It has been due to external things. Things are getting back to the shape. Even margins were affected because when the business growth, even though it is secured by order book, but business is not lifted by clients, you have prepared organization for certain size and the clients don't lift the material or defer it, then operating leverage goes against you. That affects your margins. Their margins were affected because of that too. In the current year, we will see relatively that challenge on the top line will again come down, and therefore top line will increasingly as we go from first to the second to the third quarter, and the top line will grow at a faster pace. Margins will expand. And similar to what I talked about page industry, you will see a phenomena where expanding top line and expanding margin, and the two together will create a rising crescendo on the profits over a period of time. So it's a business we need to be a little more patient with. It's a world-class business, technology business. It's not a humdrum commodity business. And in some of the areas, they are unique supplier in the world where there are no other competitors. So it's a business which is deserving credit.
So investors, I'm taking a few questions and not taking few because as you know, there are a lot of individual portfolio questions. And at the end of 45 days, you know, that fund managers will speak to you and answer each of the stocks which you have asked. So I'm taking few questions of the stocks which are common across majority of the strategies and not taking some of the individual stocks because they will be covered in detail. Post 15th of August, we will again have, after the results of the first quarter, each of the portfolio manager will answer. So maybe I'll take last 1-2 questions and I'll ask Mr. Avinash Sharda has asked these questions. Do we see challenges ahead for Asian Paints? Again, it's across a lot of portfolios. I'll continue the question. He said with bigger competition like Grasim and JSW joining the game, do you think there'll be a threat to Asian Paints? Again, it's stock we own across all portfolios. So I'm asking that to Bharat.
Once again, if you look at last year, the murmur about Grasim coming as a competitor and a large competitor. Clearly, Grasim is not a small competitor. Grasim is the biggest, Ultratech is the biggest cement maker in the country. They want to use the same distribution channel to sell the paints. So there's some amount of synergy also, and the financial muscle if that needs into the offering. So there were concerns, there were worries. Price came down by 25% from the peak. But today, if you look at it, once again today, I mean, it is hardly 5% away from lifetime new high. I mean, Asian Paints, which came down to 2,600 last year, sometime during the last year, today is at broadly back to 3,400, and it touched highest in its history of about 3,500 plus somewhere, 3,550 or something of that kind. So it is more or less close to its lifetime highest. It's not as if it is away. Secondly, competition is not necessarily a threat. Competition many a times is an expansion of an opportunity, especially for the leader. Uh, Thirdly, if you say JSW, JSW is not entered into paints today. JSW is now selling paints for 11 years. So it is not as if JSW has come today. And while it has been around for 11 years, it is not as if Asian Paints has lost market share. In fact, Asian Paints market share has grown in that 11-year period by a few percentage points. Ultratech and Grasim could offer a challenge and could offer a competition. But again, these advantages that a business builds is over decades and decades, those are built. Efficient supply chain management, ability to supply products to your distribution line in 8 hours and 16 hours and 24-hour timeline that dealers don't require to maintain much inventory at their end. Distribution relationship that you've built over a period of time. Automatic sales and demand for the product that you have built, and therefore it is a source of profits for your distribution network in the dealer network. Plus the fine tuning of the brand, fine tuning of the marketing, close understanding of the business and how you're built. All of these are the advantages which are hard to fight even over a meaningfully long period of time. And if it is a sleepy management or lazy management, then the task for a competition becomes easier. But Asian Paints is far from that. Asian Paints is continues to be very efficient company and continues to be very alive and agile management in dealing with the market situation. Plus, Asian Paint itself is expanding its moat one by one. They started with the kitchen related supplies. Then they started with the paints contracting activity as a business. Then they've entered into, fittings and accessories as an activity. They've entered into construction chemicals, which is again a large activity. So they too are beefing up their own opportunity set. It is not as if they are only in one area. And many of their other non-paint businesses are now significantly getting to be large. And finally, the all of these advantages. If you look at some of the biggest global paints companies which came to India, people like Nippo, people like Sullivan, some of the biggest players in the paints industry which came to India. After a decade and a half, many of them left India and they couldn't really compete. They couldn't really build a scale. So don't assume that just because somebody can use a distribution network and somebody has financial resources, automatically business can be built, and the leader will lose the market share. That proposition as yet has not been proved, and time will tell whether that is happening or not. We are watching the situation, but so far none of the results seem to indicate that there is anything which is amiss.
Lovely. Thank you, Bharat. I'll just take the last question now. It's already 5:15. And again, a question which is across all our a stock which across all the portfolios. Mr. Neil Shah and Mr. Samir Kulkarni has requested to answer your thoughts on Bajaj Finance on two parameters. Again, entry of competition. If Jio's entry comes in, then what will be the impact? And second, they put is size a deterrent now for Bajaj Finance to keep growing and compounding as it done in the past?
On the first question, whether competition, I would say size of opportunity itself is so large. In a growing economy, therefore the size of opportunity further grows large. Earlier I mentioned that why lending is a favorite area, because all conditions seem to be fully aligned. Cost of capital has come down. Lender balance sheets are among the best in the world, not just best compared to their own history, but best in the world, I would say today. The asset quality apart, leveraging on lender's own balance sheet is more modest than it ever before. Borrowers have reduced their leveraging, and therefore they have a space to borrow more. And many new opportunities of lending have come up. For example, new capital formation for new capital expenditure. Now, very clearly signs are there that why that will continue to get up. MSME, rural area, a lot of powerful engines of growth have opened up, and which is doing very well. So I think Geo Finance, we'll have to wait and see how they will do. But there is a space for a lot of players. And lending as a business, the tricks of the trade and experience is built over a long period of time. It's not as if just because there is a check to be returned, that automatically new business can be built. Of course, writing out checks and giving money to somebody doesn't require too much of effort. If you want to distribute money, there are enough who want to borrow money. But to do a good lending, so that you not only lend only to some people who deserve to be lent to, who have wherewithal to pay you back, therefore your asset quality is pristine, that you lend it at a price where it leaves enough margins for you, that you manage your liability and asset side matching both on duration and on cost properly, so that there is no misalignment of cash flow, as well as there is no impact on the margin. All of these are learned and built in a healthy way over a period of time. Whether a new player entering the game is a small player or a mid-sized player or a large player, everybody has to go through the same learning curve. There are no easy ways to deliver a baby in less than 9 months. It will take 9 months, and if you try to make it too early, then there are going to be issues. And therefore, given the fact that size of opportunity is large, and Bajaj has built a model and refined it over a fair period of time to show that how they remain continuously on the ball. So that is on the first question of competition. Second, whether they become too large to be able to grow at the same pace. I'll answer it in this way. Look at the December quarter numbers. They reported highest return on asset in their history and highest return on equity in their history. Come March 23, they reported even higher ROA than December quarter, therefore the highest ROA in the history of the firm. Standalone ROA at 5.35%, and standalone return on equity at close to 32%, unmatched kind of numbers for not just any lender, but also for Bajaj Finance itself. Not only it reported the highest ROA and ROE, it reported also the best asset quality in percentage terms ever in its history. At just 0.3%, it was an unprecedented kind of a superb quality asset book that they have notched up. You had a few days back the data about their June asset under management number. In a single quarter, the asset build-up has been up by 24,700 crores. I mean, in a single quarter, they have added 24,700 crores. While their deposit base, the asset base grew by 32%, deposit base has grown at even more astounding 46%. Now, on a large base, they have continued to show that. In terms of the new customer addition, the total customer franchise as on June has crossed 7 crore customers. I mean, this is hugely significant. It is like saying that 5.5% of India's population, whether 1-month-old baby or 95-year-old individual, average out of every 100 people, 5.5 people are customers of Bajaj Finance today. And finally, not only that, in a single quarter, the new loans that they have disbursed is closer to 1 crore number. These are some numbers to talk about. Not only that, they have meticulously been building a strong technology platform over last 2 years, which is all inclusive and which can allow you to do a lot of things apart from being a customer acquisition engine. Therefore, Bajaj Finance has been aiding many of these. Bajaj Finance has been, in some sense, an original fintech. But unlike unprofitable and dreamy fintechs, it has consistently been very profitable, risk control, and superior ROA, ROE driven model kind of a fintech. So Bajaj Finance has invested in technology not today, but 10 years back when it was just a rookie, like a company at that point of time. And from there on to today, they clearly have come a long way. But given the size of opportunity, I definitely believe even for next 3 to 5 years, I will be surprised if their asset book grows at anything less than 25% compounded on an average over the next 3 to 5 years, which means doubling your asset book every 3 years, while maintaining healthy profitability and healthy ROA, which are industry beating in any case. So generally when something goes up at a certain level, there is a natural tendency to think that it is, whether now it is a limit or it can be more. But just one last sentence on that. 13 years back, Bajaj Finance market cap was about 3,000 crores. Today, that market cap is about 4,70,000 crores. So it has gone up by some 155 times, 160 times over these 13 years. By any stretch of imagination, that is a very dramatic outcome. We have been invested in Bajaj Finance throughout this 13-year period. Our portfolios have been invested in Bajaj Finance in this entire period of 13 years. But if you look at that journey from 3,000 crore to 4,70,000 crores, it has not been an upward sloping straight curve like this, which is very smooth. It has gone through violence virtually every year. There is not a single year when there has not been sharp high and sharp low in the same year. But over a period of time, rising highs and rising lows. That is what has been the behavior. Therefore, if you look too closely, then in near term you will see volatility. If you see from a distance, then you will see upward sloping, smooth, calm kind of a slope which is going up. We believe the best way to address this opportunity is to keep watching it, but let them do their thing where they continue to produce a superior growth rate than the rest of the lending industry. At industry beating ROA and ROEs, the market cap will merely be an outcome which will keep reflecting a rise of that.
Although let me ask the closing question to you a little differently. If you have the liquidity today, what percentage of your money you will put into equities, and will you get worried by the global and domestic news which keeps coming time and again?
Nimesh, as you know me, you are asking that question to a completely wrong individual. My answer always has been all my money will go into equity because as I right at the beginning when you raised the question that people who want to partly or entirely redeem or liquidate, it is a choice available to them. But unless you have really reason to use that money by redeeming into something which you can't avoid and postpone, then obviously you have to redeem. But otherwise, what may look like a high today will be eclipsed at some stage. What will then look high will be again eclipsed. And therefore, 65,000, 80,000, 90,000, 100,000, 125,000, 150,000, these numbers people will keep discussing, keep talking about when they occur. But I think it is merely in the nature of things. That is the way markets behave. They will go up, they'll go down. But if underlying factors are sound, if the growth rate are respectable, quality of growth is sound, businesses are run by people of integrity and capability, and if we remain sensible and disciplined and buy good quality at a reasonable price, we will continue to compound, and that is the opportunity. And all other alternatives, even fixed income, for example, the way India is, to its credit, brought down cost of capital is a remarkable story. And now we have exercised greater fiscal restraint, greater current account deficit control. Inflation, therefore, has been materially tamed compared to what developed world is witnessing. It looks like a harakiri for them. And our inflation is actually lower than that of the developed world, which I can't remember since my birth ever it has happened. Where Indian inflation is lower than America and Europe. Therefore, fixed income is unlikely now ever to make any meaningful money. Net of inflation and net of taxation, certainly it will be zero or negative. And therefore, fixed income days in many important ways is hardly an opportunity. Gold is not an activity on a long term that we believe will do something materially. In any case, gold can hardly be a substitute for equity. At best, it can be a tiny little percentage of one's overall wealth, maybe 1%, 2%, if at all somebody wants. But it can't become even 5% or 10% of anybody's wealth. Real estate also cannot really compete. Therefore, there are no real choices which can make risk adjusted, inflation adjusted, tax adjusted, anywhere closer to equity returns over a period of time. Secondly, equity in itself, in my opinion, going ahead in India will do much better. And therefore, the two facts put together, if you are able to tolerate shorter term volatility and gyrations that markets produce all the time, it serves an intelligent financial sense of your money, not to do anything else other than do good quality equity investing. If you don't love your money, then you can, of course, flirt and put it wherever you think you need to. But if you love your money, and I hope you do, then I think there is no real substitute.
I think the investor got the answer which they're looking forward to in the last 1.5 hour session. So on behalf of the investor community, the distributor community, I thank you for your candid, honest answers. We exit this call and again look forward to seeing you.
Yeah, I think I just saw somebody raising a question if you can answer on Reliance, so I'll just briefly answer that. And Reliance consists of three parts of the businesses: telecom, retail, and their energy chain, petrochemicals and refinery and new chemical business that they are seeking to build, along with the new energy vertical that they are seeking to build. Telecom remains a very attractive area, and they continue to do well there. So is the retail, an attractive and a well-composed area. So I would say that both of these will continue to deliver good outcomes for Reliance. Refinery right now actually is an incredibly attractive activity right now, because the margins are very healthy, and they should continue to make very healthy profits. But on a longer term, that is an activity which they are trying to re-innovate by creating new energy and new chemical footprint on that. Net, I would say, Reliance in its all parts will continue to grow and perform. But clearly, hopefully, they will hive off telecom at some stage. They will hive off retail at some stage. That will be one unlocking of the value opportunity at a higher note. And secondly, all of that put together, I would assume a reasonable compounding still going ahead from Reliance. Whether it will be exceptional compounding, we'll have to wait and see for some of the developments. But reasonable double-digit kind of a compounding is something that I believe still exists in Reliance. Nimish, you are on board.
I'm saying that was the last question anyway, by somebody asking Patanjali, in case you want to take up, but I think we can take it up when Sumit talks to them.
Okay. Sure, but Patanjali continues to do right things. They have 4 principal businesses, now consolidated into actually 3. So they have edible oil as a prime business. The second business that they have is of the food. The third business is that of nutraceuticals. And fourth and very large activity potentially is that of palm plantation. The edible oil is a mature business. They continue to be a second largest player, and they are growing ahead of the industry. Industry itself is a reasonably low growth industry, 5-6% long-term growth. They are doing a little better than that, and their margins also, given the size and scale, slowly should inch up from the low level of margins that industry today has of about 2.5 to 3%. But on a large scale, small improvement by 15-20 basis point every year is still a material amount of profit. Plus, return on capital employed on a business is sound because the asset turns are very, very high. This industry is 10 times asset turns, and working capital is not very large investment. And therefore, return on capital employed still tends to be, despite low margins, between 20-25%, which is a very respectable ROC to one. The food is a very, very strong business spread over various areas. That is a better margin business, 15 to 18%. Growth rate also is better, somewhere in the band of 12 to 15%, if not little higher. And therefore, that is one engine which is going to keep driving more and more of the profitability of the business. Though food is today just about 15% of turnover, but is already accounting for closer to 35 to 40% of the profits and will continue to drive that higher. Nutraceutical is a new vertical that they've launched, and now they are merging with the food business. But that is a business where margins are high, somewhere in the range of 25 to 30%, and growth rates can easily be in the territory of 20 to 25%, if not even better. Therefore, it's a new business, but very attractive business, and something which is to be watched. The fourth business is palm plantation. That is going to be, in many respects, a game changer and a very large profit pool activity. Palm plantation basically relatively modest investment per hectare of the plantation, where a large part of the subsidy is given by government. So a lot of players have entered into that area, including some of the multinationals. And any palm plantation takes about 4 to 5 years to mature. And once the fruiting starts from the fourth year onwards, you make profits for almost about 40-50 years of almost annuity variety. The palm plantation itself in 5 years' time, in my opinion, can start making almost 800 to 1,000 crore profit. So Patanjali, I would say over a 5-year period from here, will be somewhere in a range of 55 or 1,000 crore turnover, and a bottom line probably somewhere in the vicinity of 2.5 to 3,000 crore PBT of that order. Compared to that, the valuation is still very, very attractive.
Very insightful. Thank you, Bharat. I don't know how you managed to answer every single question. And I think, thank you for your time, almost 1 hour, 36 minutes now. I think I've answered all the questions. Again, on behalf of all of us, thank you for your time and answers in detail. Investors, we look forward to your continued participation. We'll send you this YouTube link tomorrow or day after. So in case you want to rehear it again, you can do so. As many people, thank you. Share the thank you here. Yeah.
Best wishes to everybody.
Yeah. Look forward to see you all next quarter. And please do attend the Portfolio Managers conference call and webinars sometime end of August. Thank you all. Bye.
Thank you. Bye-bye.
Very insightful, wonderful. Yeah. Thank you.